As we move through the second half of 2025, markets have continued to notch new highs, more than erasing the fallout in April over tariff uncertainty. Yet the flight path of the current recovery could still encounter diversions due to ongoing trade negotiations, consumer prices and spending, geopolitics, a fluctuating labor market, and much more. As we watch for signals of both weakness and strength in the economy for guidance over the near term, the principles of portfolio construction can help shape investing strategy over the longer term. Hi, I'm Chris Heisey. Today I'm joined by Joe Curtin and Rolando Castellanos, two colleagues in the Chief Investment Office, to get their perspective on portfolio construction and why a principled approach is especially valuable in today's market environment. Joe, Rolando, thanks for joining me today. We're going to talk a little bit about portfolio construction in the context of what's going on now, what has been going on as it relates to headline risk, geopolitical risk, significant volatility. Joe, let's start with you. What does a well-constructed portfolio mean to you today in the context of everything we're dealing with?
First of all, a portfolio should be purposeful, meaning it should meet the needs of the client, commensurate with their risk tolerance over a certain time horizon. And that purposeful portfolio typically is a mixture of stocks, bonds, and cash. But as someone's needs grow, their wealth grows, then bolting on other satellite portfolios to a purposeful portfolio makes a lot of sense. For instance, let's say inflation protection. Having a real asset portfolio would mitigate future inflation.
I'm going to shift over to Rolando for a second here. Let's talk about alternatives today. How do you think about adding alternatives to a purposeful type of well-constructed portfolio in the context of what's going on in today's world?
I think it's helpful to start with what alternatives can bring to portfolios.
Right.
What are they designed to do? Fundamentally, three simple things. Number one, improve diversification. Number two, provide access to growth and investment opportunities that might not be available in public markets today. And number three, help manage volatility, right? Pretty straightforward. In terms of what comprises the universe of alternatives today, there is private equity, which tends to be about return enhancement. Private credit, which is about generating high levels of income. Real assets, which we touched on in terms of both real estate investing broadly and then infrastructure investing, those tend to be about stability and inflation protection. And then the hedge fund universe, right, which is about managing volatility and diversification, right? Each of those have very different risk and return profiles such that they lend themselves to different roles in portfolios. So bottom line for us, they're no longer just, let's say, niche investments that only the wealthiest individuals or the biggest institutional investors have access to. We are seeing each and every day more and more investors using them as tools to build resilient portfolios. And that's the way we're looking at alternatives now.
Now let's talk a little bit about rebalancing, tactical asset allocation. Talk about the different steps that are involved.
Yeah, with what we've seen in the economy as it's re-globalizing, we're seeing these bouts of volatility. They come fast, they come frequent, but the recoveries are just as fast.
Right.
So whenever we see these extremes where asset values get highly appreciated or the markets really sell off, it's a good opportunity to rebalance, shave your winners, buy the losers, and expand out the parts of the portfolio that perhaps you don't have exposure to.
And tax efficiency, is it more important today than ever before or still important just in a general sense?
I would say it's one of the most important things to do. You might have positions that have run up in value. You've got some really low cost basis. And if you were to sell those things, you've got a very high tax hit. But then there's other parts of the portfolio that haven't done as well, where you might be experiencing losses. And offsetting those two allows you to get back to that rebalancing position also. We haven't seen tax laws like this that are so favorable to individual investors in a long time.
Right.
So investing for tax efficiency, but also taking advantage of the new tax bill, I think is tremendously important.
One component of alternative investments that is often not talked enough about is liquidity. How should we think about the liquidity or lack thereof when it comes to alternatives?
Right. Liquidity is one of the key things to keep in mind here because as with everything in life, I would say that the virtues can also be the vices, right? And liquidity is a trade-off here. Alternatives, generally speaking, they're long-term in nature and they can help clients achieve their goals over these longer horizons. But the sacrifice, the trade-off can be liquidity. Capital can be invested for many years, right? In exchange for that, a compensation, a return premium should be earned in order to kind of justify that investment.
So we've talked a lot about change, volatility from time to time, significant headline risk, geopolitical risk that's kind of there all the time. We also talk about monitoring that. Rolando, we'll start with you in terms of alternatives. How important is monitoring an alternative investment portfolio from your perspective?
It's critical. They still require active management, which includes monitoring, right? But it's not a set and forget it strategy because the allocation may not achieve the level of size and scale that you intended when you initially began investing. You need to top it up. Conversely, there may be opportunities to take some limited liquidity, which allows for rebalancing, reinvesting into new thematic opportunities as the market evolves, right? The manager selection component, all of that goes into this active element of investing in alternatives, including monitoring, because you don't want to lose sight of it.
That's a great point. Joe, how about monitoring from a public portfolio perspective?
Yeah, I think three things, right? Life would be one, then markets, and then policy. So life happens. And with that, often when we create an investment plan, we have some view about the future, but we may actually do better, or sometimes we have a setback. So reevaluating the overall portfolio positioning, given those sort of life events that happen. The second is markets. So markets will run up, markets will become concentrated, and then they self-correct, and then they're back to the races again. So whenever we have these extremes in the markets, it is about rebalancing. Then the third is policy. Policy could be very stimulative, right, from a tax perspective, as well as policy trying to attract capital into the areas of the markets that the governments want to really accentuate, right? So whenever there's a policy change, reevaluating, do I have the right investment strategies in place would be pretty crucial.
Let's put this in a summarized perspective. When it comes to portfolio construction, what are 3 or 4, perhaps 5 main items each of you want investors and advisors to think about?
I'd say the first is really being fully invested, right? You can't really time the markets all that well. Increasing diversification across and within asset classes. Tax efficiency just can't be overemphasized, right? It's not what you earn, it's what you keep. And then we haven't had attractive yields like this in a very, very long time. Leaning into those yields would be really important. And then I'd say finally, rebalancing when we have these big sell-offs in the markets.
Right. Rolando?
For alternatives, I would say diversification is always paramount across strategies, asset classes. You want to be investing consistently and committing capital over time in order to get exposure to the different investment themes and market environments that kind of move through a cycle. I would also say the manager selection and due diligence component in alternatives is critical, given that extremely wide dispersion of outcomes and performance. And then lastly, the strategic approach is most important in order to align with the less liquid nature of the broader alternatives universe. That said, you can still take advantage opportunistically of long-term kind of structural trends and themes.
All great points. Great discussion. I want to thank you both. Joe, Rolando, thanks for joining me. Remember, while these portfolio construction principles are foundational, markets are constantly evolving, and your personal circumstances change over time. If you work with an advisor, connect with them regularly to review and reconsider the composition of your investments. Your advisor can help ensure these principles are properly applied to your unique situation and adapted as market conditions shift. Thank you for watching.